Today's webinar is about understanding how the financial markets, commodities, stocks, currencies, how they are expected to perform for the next year. And we'll discuss about how 2022 has been, what sort of critical issues we have faced as investors, and 2023, how it's going to be like. Now, obviously, the information and facts we are going to discuss over here are based on certain assumptions, are based on certain calculations and mathematics. The idea is that things can go completely different also as the year progresses, because there are a lot of events which we cannot presume or will always be uncertain. And that's where the role of financial consultants come in. When you're devising a portfolio, or when you are talking to your risk consultants or financial consultants, what you have to specifically focus on is what happens in case if your plan does not go well. If you have planned to invest in just tech stocks, what happens if tech stocks starts coming down? Do you have a plan B? Do you have a proper risk management? And that's this session is all about: understanding how you can diversify into different sectors, how you can diversify into different investments, and more stress on risk minimization. A lot of investors, they expect these sessions to provide some sort of tips or hints or scripts that which is going to perform well. But the whole idea is that there is no shortcut to make money. All you have to do as an investor is focus on minimizing your loss. Probably you end up in profit, and that's the way to look at your investment. Every penny you invest should be stressed upon reducing down your risk or managing your risk well, reducing down your loss in case of an uncertainty happens, right? So today's session is going to be about that. We are going to share a lot of information. We are going to go back to 2022, what has happened so far, and then we are going to understand what 2023 is all about. Since this is a webinar, and I understand there must be a lot of people here who will have some questions, you can use your chat options and ask any question right here, which is related to financial markets. I'll try to answer the question right away while we are doing the session, or by the end, or if I'm not able to answer, anybody from my team will definitely reach you out by the end of the session and will definitely provide you an answer with. So if you can hear me properly, and now is the time to try your chat options. If you can hear me properly, if you can see my presentation, just give me a yes or okay, and I can proceed with my session. And that way you'll be able to try your chat options as well, and you can ask me any questions about the investments you have. So if you can hear me properly, please use your chat option, write yes or okay, so I can take everything is audible, everything is clear, and I can start with the session right away. Right, okay, perfect, okay. So I assume most of you have said yes, okay, we can hear you, done, okay, perfect, okay, great. So I see most of you can hear me, which is great. Just in case, if you have to go somewhere, or if you're not able to complete the session, the recording of the session will be uploaded on YouTube. You can always view it later. The whole advantage of doing the session live and listening to this live is, but if you have any questions right away, I can try to answer and do it. So without further delay, let's try to understand how this year has been. What's the current market scenario like? What has been going on with the markets? What are the news which are important? And then how the another year is going to progress. So we have seen year 2022. I mean, this has been one of the most roller coaster years, and it happens because um, this particular year it presented investors with a particularly difficult environment, and the biggest concern was inflation, because not only 2022 was a concern about inflation which went on this year, but also when this year was in the middle and when it all started, we have seen the onset of the war, in Ukraine, which drove a lot of price levels up, and that actually added to the inflation. And in response to that, central banks, and especially when I say central banks over here, I will be mostly talking about US central bank, because a lot of uh, price movements, a lot of volatility revolves around how US Federal Reserve or the US central bank treats the interest rates, increase it or decrease it, and that's going to be one of the most important discussions over here. So we saw that US Federal Reserve, it first and foremost, we saw that particular central bank, it brought forward the rate hikes. They have done it, they have demonstrated, they have been very determined to bring inflation down, and they have been increasing rates, and that's why we have seen there have been a rate hike. The current rate is around 4%, more than 4%, and it has been very, very aggressive. But entire year we saw a big struggle from the central banks, and not just US but across the world. It's been a huge struggle to control the inflation. And if you see throughout this year, while they have been raising rates trying to control inflation, global growth has been slowing down. So if you see currently, when we speak about, a lot of analysts have spoken about this, that Eurozone, United Kingdom, they're very much on the verge of getting into recession. Probably 2023 is the year where we'll see Eurozone and UK likely to have slipped into recession. And looking ahead, when we see the financial market volatility um, is only expected to increase, because the global uncertainties are still there. Uh, the financial conditions are still very tight, and this is going to be a very, very challenging year for a lot of investors. And that's why we have to understand that which are the risky assets we have to be away from, which are the sectors we can look into. And as we say, uh, volatility creates opportunity. And 2022 has come up with some different difficult challenges. So was 2021, so was 2020, so was 2019. But nevertheless, investors can always find opportunities. And as of now, when we see that the interest rates are too high, so when I say opportunities, particularly in fixed income products like bonds, right? And we are going to discuss about this in investment outlook. And I think there are a lot of other sectors also which we have to see, because there are a lot of other uncertainties like war situations between Russia and Ukraine, where that had triggered an energy crisis. Food prices went up, energy prices went up, and that is also something which we have to keep a check uh, when we move into 2023. So, and we should understand one more thing: the inflation what we saw this year, it's been a 40-year high. So this is not some normal year which has gone by. Yes, something has been very significant has been happening, and that has been the high rise inflation, and that has been a 40-year high. To look back how 2022 was, we saw a lot of tech stocks going down. I'm just going to issue a quick poll just to understand how many of you have been invested into tech stocks, because that's where we are going to see. Um, just right here. Have you invested in any tech stocks this year? Yes, no, and right here. So you can see a poll in your screen right now. Just want to understand how many of you have invested in tech stocks in 2022 or even 2021 counts. If you have still open investments in technology companies, let's try to understand. Okay, okay, okay. Because we saw 2021 mid-October, there has been a big decline in the tech stocks, and that included Apple, that included Amazon, that included Facebook, Microsoft, Alphabet. And we saw that a lot of investors who already had bought tech stocks, they did not close it, or they did not sold those, they continued to hold on to it. And even in the beginning of 2022, mid 2021, when the stock started falling, and then we saw the beginning of 2022, the stocks continued to fall. So there was a big, big decline in the tech stocks. We saw oil prices soaring high due to Russia and Ukraine war, and that happened. Oil reached almost $200, and that was something which was very, very significant, because oil prices, as we know, in pandemic was it reached as low as negative, and then after 2 years we have seen jumping up to 100. We saw COVID policies in China became so strict that started hurting the stocks. I think it's been barely a week or more that now China has loosened up the COVID policies, but the entire 2022, we saw the most of the equity indices declined in China due to very strict zero COVID policy, and that has impacted the entire global supply chain. And that has been one of the bigger reasons that why we are seeing Chinese equities fall, apart from technology regulations and property crisis. Then we saw central bank doing rate hikes, and that has been something which has been the news entire 2022, trying to control inflation. And we have seen equity markets reacting to it, stock markets reacting to it. We have seen Nasdaq, S&P 500 declining due to that. We saw Europe going through a big energy crisis. And due to inflation, US stocks around the world went under pressure. We saw pound falling down a lot, becoming a lot weaker because of the dollar strengthening. And otherwise, we saw a new UK Prime Minister, Rishi Sunak. He became the Prime Minister of UK. We saw midterm elections where Congress, now earlier Congress belonged to Democrats, Joe Biden, and now House of Representatives have belongs to the Republicans. They have regained it, and that's why this year is going to be extra important, because not only there are a lot of changes happening, but also we have seen over here that the midterm elections have went on a different side, where now Congress is being shared by Republicans. So that's where we stand as of now, and that's where we see the current market scenario, where the 2023 will have high inflation challenge. We'll see whether central banks are going to raise rates, continue to raise rates, or will be able to control inflation or not, whether it's going to be a slowdown or not. And that's what we have to discuss about. And let's start with a few sectors. So mostly when the outlook comes across uh, different ways, we talk about stocks as a whole, we talk about commodity as a whole. Today we are going to try a different approach, and we are going to talk about specific sectors, because believe it or not, there is always an opportunity in equities, because there are different sectors, and sectors react to the current market situation. So if, let's say, there is a possibility of a recession, for example, more investors would look towards defensive sectors. When I say defensive sectors, that means those areas, those industries which do not fluctuate a lot due to recessionary conditions, and which also provides a fixed dividend during this time. And that is really important, because when you see economy on the verge of recession, and when you see financial markets going down, there are still few sectors who will give you a fixed income in the form of a dividend, and the volatility in those companies will be really less. And I think that's really important. I always keep a notepad with me. If you want, you can keep a notepad with you, note it down, what you feel is important, and I think that should help you out. So starting with healthcare, and that's really important, because now we are looking at the outlook of 2023 specific sector wise. Now when we are looking at healthcare, and that's really important, that has been one of the most important areas when it comes to defensive sectors, because from every particular outlook we have seen healthcare has been very reasonable. It has, if we talk about the valuation of the companies in the healthcare sector, and healthcare is one defensive sector. There is consumer utilities, there are other companies as well. But then when we look specifically at the healthcare companies, the valuation of companies in the healthcare is still much more appealing. And if I see a broader perspective of the entire sector, specifically the companies which are noticed right now are healthcare equipment companies, which are expected to drive the growth in 2023. And when we see, because if USD continues to get stronger, now everything is connected over here. If inflation is not under control and we see inflation rising higher and higher, and central bank continues to raise rates today, also there is a Fed meeting, and central bank is expected to raise rates, maybe not at the same aggression as it was supposed to be, but it is still expected to increase the rates. And if this goes on for another 1 year, 2023, we might see dollar getting further stronger, and that could be one thing, because a peak in USD could be a risk for this particular sector, because um, it benefited meaningfully from dollar strength in 2022. And as of now, I think if USD continues to become stronger, still good for healthcare stocks. But at any point, if inflation comes into control and central bank decides that, okay, now inflation is under control and we are not going to raise rates much, or not at the same pace, we might see USD start getting weaker, and that could impact the healthcare companies. So that's one risk which the healthcare sector follow, and that's the currency risk. But again, the major proportion of that risk is diversified as you look at healthcare equipment companies, because healthcare equipment companies are really important ones, and we are looking at long-term growth drivers here. So when I'm talking to the investors over here, I'm talking to all kinds of investors. I'm talking to short-term investors, I'm talking to long-term investors, and specifically for investors who are long-term, who would like to hold on to their positions. Healthcare sector could be great for long-term growth, because not only healthcare works well in emerging markets, because emerging markets have people, have population which works, and there are a lot of aging population, not just works, but there is a lot of aging population which comes across in emerging markets. And that's where healthcare performs a very significant task. You talk about developments of new healthcare technology, you talk about developments of mRNA vaccines, you talk about development of healthcare equipments to deal with the aging population in the emerging markets. All of that combined gives this particular sector a lot more weightage. So if you have a portfolio at the moment for 2023, make sure that healthcare does not get neglected. And especially I'm talking about healthcare companies, not just in US, but I'm talking about healthcare companies in emerging markets also, because that is something which is really, really important, as emerging markets have a lot of aging population, and there is a lot of scope for development of healthcare technology. Looking further, energy. Now, energy, talking about fuel, 2023 is going to be a bit challenging for the energy sector. 2022, we saw oil prices soaring high. 2023 is likely to be more challenging. Uh, we are currently looking at uh, earnings of specific oil companies. It is expected to probably decline a little bit. And when we see within energy, we have to understand one thing. So there was recently a news from Russia. They are likely to cut down the production of the oil, which can still push the oil prices high. But then we have to see a broader perspective, because a lot of investors, they only look at the OPEC meetings and the production and the demand. If Russia reduces down the production, or even later on any other economy reduces down any other country reduces down the production of the oil, we should also be ready. Uh, what happens if the demand for oil also goes down? Because 2023 first half, the growth and the economic slowdown is expected. As I said, UK and Europe are expected to be slipping into recession, and that could uh, also bring a economic slowdown also. So that is something which we have to keep into account. And that's why for energy or oil price is going to be challenging. As simple as that. If there is a decline in the total output, if there is a decline, or if there's economic slowdown, the demand for oil is also going to come down. So we might see oil prices not as high as it was in 2022, and that's really important. But again, as I said, every sector has challenge, every sector has opportunity. I would suggest that you talk to your financial consultants and look at specifically in energy, exploration and oil production companies. They are the most vulnerable sector in energy for this particular year. And there is another sector called integrated oil and gas companies. Even these two, three sectors are really, really vulnerable. But if you see those companies, like for example, equipment or services, for example, those companies which provide equipments and services for extracting or refining of oil, that can still be profitable throughout the year. Because as we see, there is a certain amount of capital expenditure which every oil company does, right? Demand high or low, but there is a certain amount of capital expenditure. There are companies which still buy oil exploration or oil refining technology or refining machinery, right? Even if they are not producing oil, there is a certain amount of capital expenditure which is done by every company, and that is expected to remain same, not being impacted. But especially those companies which are into production and exploration of oil might get impacted, very vulnerable. But those companies which are providing equipments for refining of oil, or for other services, those companies are still expected to remain profitable. So what we understand from the energy sector is it's a challenging year, 2023. Oil prices likely to remain around 65, 70. But the whole idea is oil production companies might get impacted, very vulnerable at the moment. However, those companies which are providing equipments for refining to oil companies, that might still be profitable, right? So you see that how every particular sector has certain industries which can be benefited by a certain event, and cannot get benefited by a certain event. Another example I'll give you, communication services. Now look at service, the other sector, which is communication service. And this is also something which is really important. So communication services, I'm talking about mostly telecom companies or media and entertainment companies. And this was the worst performing sector in 2022. And again, as we see that if there is another slowdown in the economy. So I'm talking about, let's say, advertising company, for example, that becomes the part of communication services industry. If there is an economic slowdown in 2023 in the first half or first 6 7 months, companies are likely to advertise less, and that impacts the revenue of an advertising company or a media and entertainment company. To 2022 was such year where we saw this particular sector performing worst. But due to this particular decline in the sector, I think there has been certain opportunities also, because valuations of these companies have come down. These are no longer expensive, right? And this particular year, there is a possibility that earnings are still expected to grow better than expected. And media and entertainment stocks, so when we go back in the history, we have seen the media and entertainment stocks, they still have the highest growth potential, right? And if you wish to deviate from too much exposure in media and entertainment, look at some telecom stocks which are cheaper also, which have good dividend yields also. So what I would tell you is, in the communication services sector, pick out some telecom companies, see how much they have fallen down, and what is the dividend yield they provide. So there are a lot of telecom companies which are at a cheaper price available, because the sector has gone down a lot in 2022. Media and entertainment is one of the highest growth potential we have seen back in the past. But if you want to play safe, or you're a risk averse investor, continue to pick some telecom companies which have good dividend yield and are at the cheaper price right now. And I think that should be something which you should be focusing at. So if you see within communication services also, there are a few sectors which you can be away from, and then there are a few sectors which you can use for your own portfolio, which companies, basically telecom companies, which gives you a good dividend yield. Followed by another sector which is consumer discretionary. Now, consumer discretionary is a sector, we are talking about luxury sector. Now, this particular sector has a certain loyal crowd, which is the premium customers, right? the premium consumers who buy luxury goods. Now, in 2023, this sector might perform well because, again, one important part of this particular sector is that when inflation rises, this particular sector is capable of passing that rising cost to the consumers very effectively without impacting their profit margins. And there are a lot of companies in the luxury sector, the valuations are still very attractive. The consumption trends should remain supported, because now one thing which we should take into consideration, which was not there 2 3 weeks ago, that China is opening up. They have already removed their zero COVID policy. So we expect more and more consumption from Chinese market on this particular sector. Normally, when we expect recession, people normally deviate from consumer discretionary, but that's why we have gathered today, just to understand a much more detailed understanding that this year was something really different. China is opening up. Consumer discretionary or luxury goods sector is one of those sectors where companies can easily pass on the cost or the rising cost to the consumers without affecting their profit margins. So, followed by a margin resiliency, which we can see in this particular sector, um, there is a possibility that consumption should be supported by the Chinese economy also. But again, as I said, first half of 2023 is going to be very, very challenging for a lot of sectors, because if there is economic slowdown, if inflation is not under control, if central bank continues to raise rates, then we might see a decline in all these sectors. So we have to be very careful. First half is going to be very, very noticeable, and that's where we have to find out. Because of lately, the current news which has come after today, the central bank's decision, will see what will happen to the inflation for another 3 months. Look what the inflation looks like. If it is getting under control, then central bank might not reduce their interest rates, but continues to either rise it at the very slow pace or by a very smaller margin, or just stops raising it. Either way, it will be a good news for the consumer discretionary sector. So these are four sectors which we discussed right away. If you have any questions, please do ask. And I think that there are a few questions which are coming in. I'll try to answer these once we are done with the session. Look at few another sectors, consumer staples, for example. And consumer staples is also, so we talked about consumer discretionary, right? When we talk about consumer staples, what is this particular sector? I'm talking about anything, imagine in your mind something most essential which you always need: food, beverages, household goods, hygiene products. I mean, this even includes alcohol and tobacco, but again, investment in those is entirely your choice. But when we talk about consumer staples, we are talking about a set of essential products. Now, this, unlike consumer discretionary, which is luxury, consumer staples is more of a need, right? So there are, and if you look around, there are a lot of companies which are provided. Like for example, if you look at companies like, for example, Tyson Food, or if you talk about other kind of grocery-based companies, for example, supermarket companies, Dollar Tree, any other particular stock you can think about. All of those are consumer staples. Supermarkets, grocery stores, food and beverages companies, and all of them essential products. These are consumer staples. And during recessionary conditions, a lot of investors, they turn towards these consumer staple sector because they provide attractive dividends. Dividends is something which, if you are buying a stock during this kind of volatility, always look into how much dividend it provides, and that is something which is one of the most important part over here. Because consumer staples, we have to see one thing: this particular sector has a lot of high quality companies, and the volatility at which they make money, it's not very high. And that's really important, because you need good quality companies, less volatile companies with the prices should fluctuate less. And then last but not the least, we're talking about margin resilience, right? Margin resilience, again, if inflation increases higher, the cost of raw material should be efficiently passed on to the consumers without affecting the profit margins of the company. So that margin resilience is something which is really, really interesting portfolio component in the long term. And for risk averse investors, these kind of companies should make a lot of sense. So, and we have seen historically, when bond yields go up, this particular sector comes down, right? But as of now, we have seen in 2022, bond yields were going up, but this particular sector, it remained, uh, I would not say untouched, but the sector was less volatile as historically what we have seen. So the higher yields did not um, uh, reflected in the price of the consumer stable sector, and that is something which is really good. The only thing is what we have to see uh, when the market consolidation happens, because at the end of the day, growth concerns are still there, and growth concerns will always be there. But as far as we are looking from a risk averse point of view, if you don't want too much adventure in your portfolio, then consumer staples could be one of those sectors. And I'm talking about all those companies related to supermarkets, related to food and beverage, and select good quality companies. This is something which we have done these sessions in at different places, and every single time when the investors ask what sort of stock should I invest in, sector is one thing which you have to look, but the choice of the company, good quality, less leveraged, high margin resilience, and high market concentration. The company which has not many competitors, the company which can easily pass the rising cost to the consumers without affecting the profit margins, less leverage, and good quality companies. It doesn't matter whether the prices are low for those companies, it is only a good buying level to enter into it. You want to know more about what sort of these companies are, you can talk to our financial consultants, and on the basis of your risk and income objectives, we can line up a few companies which you can look into. And if your risk appetite supports that, then that is something which you can include in your portfolio as well. But always consult your risk managers first before you enter into any sort of investments. Another sector in the equities which we'll be looking at, financials, because financials, rising rates are definitely looking at um, a beneficial part for the financials, because interest rates go up, interest income earnings will go up. The only thing which might impact this sector is the slow global growth and probably a recession risk, because that is something which we have to be very careful in 2023 about. A lot of analysts have talked about a possible recession in US, in Europe, in UK, and that is the only thing which can impact the financial sector. Um, Again, as we look back in the past, recessionary conditions have impacted the financial stock, financial companies. But unlike in the past recessions, at this particular point in 2022 and 2023, that this entire sector looked very resilient. Banks are in a much better position to weather this entire risk, and that is something which is important, because the banks right now have much healthier balance sheets as it was supposed to be in 2008 and before that. So that is something, the stronger balance sheets definitely provide some cushion to absorb the losses. And I think the fundamentals, they look really appealing. Valuations are cheap, and I think when we look at the earnings, it has a lot of earnings of these companies have started to improve. And if the rates continue to go higher, these stocks are expected to perform better. So unless there is a very big downturn or a very big slowdown, I think financials can do really well, because a lot of these companies, they have good dividend yields also. And the banks which are here right now, a lot of financial banks are at a very good position. Their capital requirements are on point, regulators are keeping a check, and any sort of slight downturn, these companies can absorb the risk, unlike it used to be back in 2008 where companies just used to collapse. Obviously regulations have become much stronger, and that's why their capital requirements have become more stronger, and the banks are in a much better position to absorb these losses. So unless there's a very huge, significant downturn, I think financial is one sector which you can look at, and specifically those companies which are providing good dividends and less volatility. So let's stick to that. Another area, utilities, and when I say again, I'm sure this is self-explanatory, but when I say utility stocks, and I'm talking about companies like any company which is related to generation of electricity, basically all the utility sector. You talk about Next Era Energy, you talk about National Grid, you talk about American Electric Power. All of these companies, anything which is related to providing basic services. So whether it is electricity, whether it is natural gas, whether it is sewage or water to homes and businesses, all the water distribution companies. So this sector, again, it's a very defensive sector, and it is said that utilities are mostly immune to what happens around the economy, because you still need the electricity, you're still going to pay for the electricity, instead of what happens across, you still need water to drink, right? So all of those companies, they come into utility, and from for the utility sector, we have to be looking at from a very different perspective, because there was never all blue government. And when I say all blue government, that means there was never entire Democrat in the last few years, not never, but the last few years, until the US midterm elections came in and the House of Representatives became Republican. Before this, we saw Joe Biden passing a lot of bills to bring renewables in the picture. Now, utility in 2022 was strong. The entire sector was strong. It got benefited from the other side of the market. So, as I said, that when things are uncertain and investors, they get confused where to invest, what to do, they look towards consumer utilities, because these are some sectors which people or investors, they always expect that these are going to perform well. So similarly, when we look at the other side, the technology did not perform that great, and people started moving money out of technology stocks, they started putting into utilities, and that's why we saw utilities performing really good in 2022. And in 2023, also, I feel that the macro environment, when we see, it's expected to remain favorable for this particular sector. Growth, even if there is a slowdown in the entire growth, recession risk, as we talk about, a lot of investors would look into utilities. So this is one thing which happens. Recessionary conditions, or if there is an economic slowdown, a lot of investors would start investing in utility companies, because these are the companies which kind of remain recession proof. Water distribution, electricity distribution, all of those companies, and they even provide good dividends. So if there is a major macro risk for the global economy, utilities might still continue to perform well, and investors will be inclined to invest into it. Earnings may not be impacted too much for these companies, but yeah, because everybody has been buying utility stocks, uh, we can say that valuation is slightly expensive. And even in 2023, if the demand is too high, we might see valuations of these companies getting too expensive. And we have to be very careful about the regulation risk and what's going on. So let's look at the bigger picture over here. Um, I normally speak about specific sectors, but this is something which we all of us have to understand. Electricity, at a lot of pension funds, they invest into utility sector, because a part of the pension funds, it gets invested into utilities, because these are low volatile, good quality dividend companies, kind of recession proof at times. But these times are different. Global warming has been increasing, and a lot of government bills have been passed on to support renewables over non-renewables. And that's why we have to be very careful when we are investing into utilities. A few weeks ago, I was talking in the ICI event, the Institute of Chartered Accountants in the Abu Dhabi chapter, and we were discussing about the financial markets outlook. And that's where the utility sector came into the picture, and there was a whole discussion about that, how the transition of um, the non-renewable sources switching to renewable is something which every investor should think about before you invest in the utility sector. So even that particular sector is something which you should look at. While you're investing into utilities, please make sure to discount the transition risk, the risk of uh, the economy and the world transitioning to renewables from non-renewables. Um, People would normally laugh on these kind of statements because you would say that, okay, I'm here for say another 50, 60 years. Why do I care about what happens now another 200 years after? But what we are ignoring at this point is temperatures are soaring real high, and there has been incidents of extreme climate change. You see Europe in winters, it's going to be extreme. We have seen extreme summers. We have seen a lot of climate-based disasters. So we cannot be completely ignorant about the role of climate change into our investment. So that is also something which you should keep a check. There are renewable funds, there are renewable energy baskets which are available on different platforms. And if you talk to your financial consultants, they are definitely going to provide you a suitable portfolio for that. Now, another sector which everybody wants to know about, IT. IT is one, I'm sure a lot of investors have invested in IT, and the big ones, right? We are talking about Apple's and Microsoft and Google. This IT, it's no secret, performed really bad in 2022. And it happens every time when bond yields go high. A lot of investors, they would prefer bonds over tech companies because the idea is very simple. Bonds are giving you 4 to 5% a year, and if you're buying a tech stock, you expect the stock to grow over a period of time, and that's a risk. So basically, if you're just being paid 5% without any risk from US government, why would you switch to technology stocks? So that's why we have seen tech stocks falling down. And if central bank continues to increase its rates, we might see IT stocks falling down further. But then there is one thing which we should not forget about. There are different sectors in technology, and there are different subsectors also. So technology is a big sector, and a subsector of technology is software and service. Software and service companies are also there, and if you see, there are software as a service. What does it mean, and what sort of companies comes into this particular? So when I say software as a service, it means those specific companies which um, deliver applications over the internet as a service. So basically, the idea is if a company installs a software, and basically, normally companies they install a maintaining software, right? Instead of installing that software in your system, there is a third party or there's a different company which is allowing you to have that service without installing in your system. You can just access it over on internet, right? Now, for what does it mean? It means that, let's say, if you have to keep a database installer in your system, instead of that, you can just go online and use a CRM service and keep your data over there. So software as a service is one specific sector in IT that has a recurring revenue, and that's the most important part because their earnings are very stable due to the reason because the revenues are recurring. If I take, so for example, I'll give you one example. Adobe, for example, back in the years, we used to install Adobe softwares in our laptops. But now you can just use it online by paying a subscription fee. You just go to adobe.com and you will be able to pick your specific service, and you can actually use that particular service by paying a certain monthly expenditure. And because you need it, you continue to pay year over year, but you don't have to install the hardware in your laptop. So that's the idea. When you're looking at IT sector, look at those companies. Normally, analysts would tell you to be away from IT. What I'm telling you is pick out those subsectors in IT which are still very beneficial, where earnings are recurring, more stable, revenues are recurring, earnings are stable, and those are software as service companies. And if you want to look at a few software and service examples, talking about Salesforce, for example, right? Salesforce is something which is a CRM based company, and if you look at few other names you will see probably over in 2022. There will be a lot of such companies which you will find, and they are related to. So Adobe, one, I told you, that's one. That there is something. Microsoft is there. There is Shopify, and there are all those companies which even allow you to build your website online without installing that. Wix.com, if you must have heard. Those companies which allow you to sign a document without having any physical involvement. DocuSign, for example, or Cloudera, all the cloud computing companies, right, which provide services on cloud. So look at software as a service more in IT sector rather than focusing on just Facebooks and Apples, right? And then material, really, really important. So with material, this is one particular sector where earnings will be at risk because possibility of a global slowdown in the first half. And this particular sector is very cyclical. We are talking about industrial slowdown. We are talking about metal and mining companies might get impacted if housing infrastructure companies, because spendings might cut back. So that is something which is one sector which is going to be really, really impacted. I think you have to be very careful, be away from the material based stock or construction based companies. If there is an expectation of a slowdown in 2023 first half, then there could be a big, big sell off. And this is one sector which will face, or which possibly face, the sharpest earnings contraction in 2023. And it could force the companies to cut back their budgets and expenditures and probably reduce even dividends. So that is also one important thing you have to keep a check on, because even a company which is in this particular sector, probably giving you a good dividend now, might cut back on the dividend later on if the slowdown continues, right? So equity style, as I said, quality companies, uh, less leveraged, high margin concentration, sorry, high margin resiliency, and then high market concentration with less competitors, less leverage, good quality, ability to transfer the rising cost of products to the consumer without affecting profit margin. These are the companies you need to look at in the sector. So, and this is really important because a lot of analysts would say, okay, this is not the year for equities, or this is not the year of bonds. That's not right. Every year is the year of equities because these are companies and we are using their products. So it's never going to be the year where equities are not going to perform. It's just you have to pick the right industry, right subsector in every sector, and there are. In IT, there is software as a service. Even in materials, I say there are a lot of. So look from a perspective. Maybe construction companies are not doing well because of the slowdown in materials. At the same time, those companies in the industrial sector, which are creating airplanes, for example, or fighter jets. So if there is a war escalation between Russia and Ukraine, arms, ammunition, and defense companies might do really well. So you have to keep a check on the war situation and see how these companies are going to perform. So there are very specific industries. Fortunate, unfortunate, get benefited from the daily events, and that's why we have to be very careful when we are deciding about their investments. Now, look at the regional outlook very quick. What we are going to see, as we have seen, US has been the center of attraction for the longest period of time. So we have to see the region based outlook also. It's going to be a very close call because for US, I think the growth is still average close to zero in 2022. It remains in the slump. Probability of recession is still slightly high, but then again, we have to see how the inflation for this particular year goes. If it goes higher and Fed continues to tighten up the central bank policy, then it might impact the entire economic activities in US. So basically, increasing rates, it makes credit expensive and enable people to borrow less because of the high interest rates, and that reduces the economic activity in the economy. And that's why inflation is the key. And if central bank continues to tighten up the interest rates, that is something is going to impact the economy. And that's why the investments in bond has become one of the much better options also, if you have to diversify. And I'm talking about short term to medium term bonds when we are looking at. And if you see Eurozone, we possibly, I feel that we should be away from Eurozone, as not only the energy crisis, inflation crisis, but also growth risk and geopolitics, possibility of a war escalation, Russia and Ukraine, and everything's going to impact Eurozone. So as of now, better to be away from Eurozone equities. UK performed probably well in 2022, but again, 2023 might slip into recession, so possibly be away from UK. Switzerland, very important. I mean, if you are willing to diversify, I think Swiss is one index you need to have a look at closely. There is a slower economic growth, but I think there is a possibility that the Swiss economy might still avoid recession because the private consumption still is better. Unemployment rate has come down, and not just down, like if you see in lowest level in 20 years, and the consumers are still in good mood for spending. Personal job security is good in the Swiss economy, and I think immigration has also picked up. So in 2023, all these factors could be a substantial growth driver. And energy prices, again, that is something which is important. But then if you see the currency, Swiss franc, we have seen Swiss franc being very stable, because I think that is currency is one of the most important point, because currency of Switzerland has been stronger, has been stable, and that's why the increasing oil prices have not much impacted at the moment. And inflation, if you see in Switzerland, is much lower than any other economy, if you see. So that is something which you need to keep a check on. Instead of Europe and UK, I would say US and Swiss still better. Uh, then we can also keep a check. Japan economy, I think we saw a good year, especially because now there has been easing of COVID-19 policies. Japan has, we have seen the Japanese yen. Um, it has gone weaker and weaker because dollar has continued to become stronger. Uh, Growth might be less in 2023, but as we know that if again, Japanese economy is also very, very cyclical. If first half of 2023 is weaker and the slowdown continues, then we might see Japanese stocks also not really performing well. So I think we just have to hold on to the Japanese stocks and see what happens. China is, uh, I think Hong Kong markets fell down 13 years low, and China is, I'm including India and China into this, the whole Asia sector. India remains one of the most important areas to invest in. And I think being an emerging market, plus there are a lot of sectors in India which are still in benefit. IT stocks now have started coming down, but they were being in benefit due to a weaker currency. Plus 40-50% of the exports, the IT services are being exported to US. So the IT sector performed well. But again, as we say, even in India, we have to pick the sector right. If the US goes through a slowdown, then IT sector might get impacted because 45 to 50% of the IT services are exported to US. But other than that, again, with India, one thing which we have to understand, the foreign investments and the foreign inflow of investments continue to happen. 2022, $3 billion worth of investments came from the globe, and there were very less percentage of withdrawals from the Indian economy. Besides that, a lot of teenagers, a lot of young, and the entire youth have been heavily investing into stock markets of India. There have been apps, there have been platforms providing zero cost, zero commissions, and that's why it has attracted a lot of investors and higher volumes. So I think India still remains a very good venue to invest into. So that is also something which you can look. China now opening up their COVID policy. I think a lot of companies which have already performed really bad at very cheap valuations. Stick to the quality names. And Europe and Middle East. Now that's really, really something really significant. What we need to see over here, because Europe and Middle East, we have seen, especially in GCC, we're expecting the growth to get better. And what we have seen also is now the Middle Eastern economies are opening up to the foreign ownerships. Also, there is very less resistance from the Middle Eastern companies to foreign investors. So whether it is the pipeline of IPOs or allowing foreign investors to come, I think Middle East is one of the areas which is expected to flourish, and followed by Far East. If we talk about East Africa, sorry, Middle East and Africa, we have seen the South African economy could get impacted by the commodity prices. As we know that gold prices have dropped this particular year, and the central bank continues to increase rates, might go down. So the lower cost of the commodities also might impact economies like Africa and others. So these are few regional outlook you can look into. Very quickly going ahead, worst may be over for fixed income securities. So a lot of investors these days now are going into bond investments. Bond yields are 4 to 5%, and if you're looking at a good corporate bond, probably more than that. But stick to again investment grades, 3 to 5 years, medium term bonds, which are allowing you to get 4%, 4.5% yield, and I think in dollar terms, it's really good at the moment. So that is something which you can definitely look into. And bond markets, this is a good time to diversify your investments from stocks to bonds. And with stocks, different sectors, bonds, investment grades, short-term maturities, 3 to 5 years, and I think that's a decent portfolio. 2023 could be an opportunity for the longer term. So, as I said, first half we'll see how the inflation goes around. And if inflation gets into control and central bank stops raising rates, we might see a potential equity market turnaround. Because um, accept it or not, before 2008, the top 10 companies by market cap were utility companies, Gazprom, ExxonMobil, all of that. But after 2008 until 2020, we saw the top 10 companies by market cap tech companies, Apple, Microsoft, Google, Facebook, all of them. And these are trillion-dollar companies. So it continues to remain an important factor in investors' portfolio. So if there is a slight element of good news coming in or inflation gets into control, the tech stocks will be the first to bounce back. So you have to observe closely and stick to the quality names and be prepared for a potential equity market turnaround if inflation gets into control. Expect earning adjustments. Again, as I said, there are a lot of sectors where earnings are expected to be resilient, but then there are some sectors like materials, for example, where earnings might contract, so be away from those sectors. Volatility as potential opportunity. Always. The worst thing an investor can do is take all your money out and sit on cash. Your money needs to be invested. It just needs to be invested at the right places. So with volatility, do not get scared. Every volatility comes as a potential opportunity. You just have to talk to your risk experts and ask them where you can allocate your funds to. And watch for key signals. Definitely watch for key signals, because central bank signals are the most important to look at. Look at the inflation data, the CPI data, that whether inflation is reducing or not. Look at the interest rates. Today is Wednesday. There's a Fed meeting. So keep a check on the interest rates, and throughout the first quarter, I think the most important thing you should do is keep a close watch on the labor data, close watch on the inflation numbers, and close watch on the rate hikes as well. Now, very quickly, we have seen commodity prices continue to remain elevated in domestic terms, because a lot of emerging markets, the prices, the currency depreciated because USD got stronger. So even when the oil prices were down, we saw in domestic terms in a lot of countries, the oil prices actually went up in local currencies, and so was with the wheat as well. So we are looking at, so if you see Brent oil, it went all the way to 100, 115, and then it has come down. So as I said, if there is an economic slowdown, then it might impact the oil demand, and it could be a very challenging year for energy stocks and oil itself. Followed by natural gas prices. We have seen natural gas prices going really aggressively high, and European natural gas reached all-time high, $70 British thermal units, and that happened in August. And that happened due to very aggressive actions by a lot of European countries. They have imported real fast. They want to rebuild inventories, and again, Europe wants to be less dependent. on the gas flow from Russia. So they have a lot of other European nations. They have tried to import more and more gas, and then again, that is one of the reasons that why we prefer US over Europe, because US is less dependent on Russian gas as compared to Europe. Plus, natural gas could be one of the most important commodity here, and the prices might even soar higher if the winters are much more colder than expected in Europe. And that is something which happens, and this is what is expected. So apart from that, I think most important commodity which everybody wants to know. Uh, so we are looking at metal demands. We are looking at gold prices. Gold prices have especially been down due to higher rates, and even there has been decline in the physical demand of gold, investment demand of gold. Even one of the most important importers of gold, which is China, was going through a zero COVID strict policy. So we have seen weaker demand for them as well. And precious metal prices, they have retreated despite rising inflation and geopolitical tensions. Normally, we see when rates are going, um, uh, we have seen rising rates, we have seen geopolitical tension. Normally, precious metals back in the past, we used to see how prices used to quickly go up, but now we have seen prices again coming down. And if you see again, if interests continue to go up, sorry, if the interest rates continue to go rise higher and higher, we might see gold prices coming down a bit. But again, as I said, a lot depends on the economic slowdown as well, because if the physical demand of gold is not too much, it doesn't matter whether rates are high or low, it will still impact the prices. Now, opportunities will be looking to 2023. As I said, that IT is one of the most impacted sectors, but that doesn't mean that there are few areas in IT which you should always keep a check on. Cloud computing, Internet of Things, artificial intelligence, these few sectors are really, really important. Even in 2023, I think you should look at those companies, software as service stocks, quality companies, cyber security. I have done different webinars on cyber security, and companies like Zscaler, Palo Alto, Okta, these companies are capable of providing cybersecurity solutions to various kinds of cyber threats. So look at cybersecurity very closely, because every year government spends billions of dollars in these companies, and I'm talking about U.S. government. I'm talking about governments all over the world. And as the year progresses and technology progresses, cybersecurity is only going to be the need for many. So that is one area which you should definitely explore for longer term in your portfolio. And as I said, stick to the quality names. Risk real interest rates. If interest rates continue to go high, stock markets might not perform up to the mark, because bonds will continue to give a better yield if interest rates go up. If there's economic slowdown, we might see a weaker consumer spending. So that also might impact these stocks. E-commerce companies, mostly during the lockdown, were performing really well. But now, since entire economies are reopened, including China, then e-commerce might not perform in the same way as it used to. And then again, there are war situations, which definitely the escalating war between Russia and Ukraine could be a decider of how 2023 is going to be for equities and other commodity-based markets. So always keep a watch on what happens to the war. And then finally, the regulations. Regulations in the technology, regulations in different areas in the economy have been. Chinese stocks fell down in 2021 due to the tightening of regulations by the Chinese government on technology companies. So regulations are something which is also going to be a defining risk in 2023, and you have to keep a check on that. So in conclusion, what we understand is fixed income, quite attractive, short term, 3 to 5 year term bonds, investment grades, good quality, giving you a decent amount of yield. Equity markets continue to remain volatile. Dollar should stay strong until inflation starts getting under control, because then Fed is still expected to increase rates. Precious metals will remain volatile depending on central bank decisions, and that is something which we have to keep a check on. Now, if you like the session, please review us on Google, and I'll just answer a few questions over here. Somebody just asked about, okay, which software as a service stocks we can look into. So as I said, software as a service, as a sector I talked about, there are companies like Microsoft is there, Salesforce is there, there is Adobe, there is Shopify, for example, Zoom, Slack, all these kind of companies. These are few of the best stocks of software as a service, and that is something which you can definitely look at. But continue with companies like Google, for example. It's not just a one specific service. Google provides a lot of other services also. So this is a very good question, guys, because even in tech, pick out those companies which derive revenue from different segments, not just one particular segment. So, for example, Microsoft or Amazon, for example, is not just e-commerce; it provides cloud computing and web services also. It derives a decent amount of revenue from there as well. So, pick on to those companies, and that is something which you can definitely look at. There's one more question over here. Is it better to send money home to fixed deposits rather than investments in stocks? See, depends on what currency. If you're talking about INR, Indian rupee, as of now, the rate of inflation, what you see, if you put a fixed deposit, it's basically your return is still going to be negative, plus the currency depreciation. As of now, I think bonds in USD will be a much better option rather than a fixed deposit at the point, because you invest in a bond, invest in dollars, you get return in 4 5% dollars, still better. Uh, Even if interest rates are 4% or 5%, and if you're getting that much, tomorrow if INR depreciates, your investments are still in dollars, you're still pacing up with inflation. And I think as of now, the situation we are in, bond investments in dollars are much better than sending money home and keeping a fixed deposit. So I think that is one of the most, I think, very good question. Once again, I think this is something which everybody should look into, because when you are keeping your money in the bank, and if you're getting a certain rate which is not even equal to the inflation, I think that followed by currency depreciation, you're just basically wasting your money. So stick with bonds at the moment, since the interest rates are high and are expected to remain high for 2023, or at least peak out in 2023. I think a short-term bond investment would be better, 2 to 3 to 5 years of maturity. Right. Okay. One more question. Can we have one-on-one sessions about it? Absolutely. So that is something which we always do. You're most welcome to come and meet our financial consultants. Whether you're a client or not, this is something which is open for discussion. This session was all about information, and that's all we are trying to provide. So if you want to come down to the office, have a discussion, definitely we are more than happy to speak with you. Just inform your relationship managers a day prior, and we can definitely sit for discussion and understand more about what sort of sectors we can look into. Perfect. How often you do these webinars? We do this every week on different topics. We have done this on financial markets outlook. We have done on cybersecurity. We have done on trading strategies. We have done on pair trading strategies, arbitrage, a lot of that. So it depends. Every week there will be a different topic, and you can always go back to our YouTube library and you will find similar sessions which we have done, and you can get more and more information. All right. Okay, perfect. I think these are the questions what we have. Any more questions you have, please definitely let us know. We are just a phone call away, or we are based in Emar Square, and anytime you want to drop in, come back, talk to us, and we'll definitely be able to help you out. So thank you so much for staying through the session. Thank you so much for your questions. I hope that 2023 brings a lot of health, wealth, and happiness for everyone. And after the session, if you will have any questions, we'll be more than happy to meet you personally and discuss this in our office as well. So once again, thank you so much. My name is Yogesh, and we'll see you next week with a different topic. And definitely looking forward for a one-on-one meeting as well in the office. You have a great night ahead.